everyone. Thank you for your overwhelming response last month. We received a number of requests on topics that concerns and interests you. Continue to write to us and we take as many as possible along with the market snapshot for the month. So, moving on. It's the second time since July 2022 that market tried calling a top on the Fed cycle, leading to a brief risk asset rally in last week of October 2022. These hopes were decisively quashed with latest US Fed meeting with a fourth 75 basis point hike. Chair Powell noted that peak Fed funds rate may be higher even as the pace of incremental hike may come off a bit. Window for soft landing has definitely narrowed. Fed needs to slow labor demand quickly and significantly, which is not easy to do in the current market of strong profit margins and above trend GDP growth. Market now expects a peak Fed fund rates at around 5.10 to be attained by Q1 2023, with risks to further upside. 2-year and 10-year US Treasury exhibit sharpest inversion since early 1980s, signaling recession risks. Bottom line is economic slowdown in 2023, resulting in asset market weakness and volatility. Dollar stays strong. Deteriorating growth outlook, fragile risk sentiment, and elevated US yields have been at the core of stronger dollar. In the very near term, strong dollar and INR pain may continue. But somewhere in 2023, Fed pause may see the USD shift into a less potent form. And when this happens, rate of depreciation in rupee could come down significantly. Also helped at that time by some resumption in portfolio inflows and trade deficit moderation. Global political backdrop is undoubtedly risky. With Liz Truss stepping down in the UK, fiscal concerns have been averted for now. There is a lack of political cooperation to solve the energy issues in Europe. The risk of a costly energy crisis in 2023 or beyond with multiple collateral damages shape up. US has openly sought to cripple the Chinese tech industry. On October 7th, it banned the sale of high-end chips to China, both by American firms and by the foreign ones that use American kit. Further deterioration in West China ties could add to trade disruption, leading to a structurally higher inflation. China concluded its 20th Party Congress. Markets' first reaction to Xi Jinping's speech was negative, as national security was elevated over economic development. Over the next 6 months, market will keenly watch out their decision on COVID handling strategy, property sector troubles, and regulation of the tech sector. COVID cases in the country are rising at the sharpest pace since May 2022, aggravating demand concerns in China. India's growth has held up despite external headwinds. An early festive season would have also jacked up the demand in September and October. The feedback from rural India is mixed, with few pockets benefiting from higher agri prices, while the others have taken a hit in yield from October rains. Centre continues to spend on infra activities and we hope for a rebound in the state capex too during second half 2023. Capex activity is picking up. However, exports is also moderating rapidly at the same time. Slow global growth will impact India's exports and manufacturing in the very near term, and these are the near-term headwinds to overall growth via mainly global linkages. Earnings for Q2 FY23 thus far has been decent with inline outcomes. However, growth is being led by GIST, BFSI and auto, with IT reporting single-digit earnings growth, while metals, oil and gas and cement sector recorded a year-on-year decline in earnings for the quarter. As the benefits of the recent moderation in commodity costs start to accrue, earnings in the domestic cyclicals could hold up. Markets have bounced back smartly in October 2022, with Nifty rising 5.4% month on month and almost wiping out the entire year-to-date decline. But valuations are painfully expensive and offers limited upside in the very near term. In the equity space, we continue to favor domestic cyclicals. Within the fixed income space, long end rose marginally, short end rose further. Liquidity has moderated rapidly. Tighter liquidity conditions along with increased deposit mobilization by banks has led to sharper rise in the short-term rates, causing significant yield curve flattening in India. In the near term, short-term rates could continue to rise. Latest MPC minutes elicit a divided opinion on future rate trajectory in India. For now, we stick to an assumption of peak repo at 650, though we humbly accept that it could be contingent on global rate action and dollar dynamics. CPI inflation in India is likely to stay elevated through FY23 and gradually moderate to around 5.5 handle in FY24. India reaching to the mature stage of rate cycle action and likely positive real yields 6 months ahead does create a case for adding duration. However, it is the external backdrop which keeps us guarded and gradual on building duration. Corporate bond spreads provide less relative value and is vulnerable to reasonable repricing as the new normal of more moderate liquidity situation plays out. Sovereign securities remain the best relative value segment currently. Signing off for this month, keep writing to us. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.